Kicks 105.5, Blake Shelton and Trace Atkins in a Hillbilly Bone. It is 7:46 on this Wednesday morning. Kind of drizzly outside.
Yeah, not so much a lovely. Hold on, let me just do this real quick.
It's a hydroplaning morning.
Oh, don't worry, that's fine.
Sorry.
I forgot to close the door.
It's all right.
But there's people out there, so I don't know.
Sometimes there are, and sometimes they're spastic and bouncing off the walls, and other times they're fine.
They're fairly quiet.
Yeah. But thank you for closing the door.
Least I could do, and create a whole disaster of dropping everything on the way. But that's okay.
You didn't do that.
That's all right.
So we were talking before we went on the air, and you said this week we're going to be talking insurance scores.
Oh, gold star for you, sir.
Is that what you said?
Yeah, insurance score. Yeah.
Okay. And that's based on a number of things, obviously, but one of them being the credit score.
Not really based on the credit score. It's based on your credit worthiness, which is not totally in line. Now, it's interesting how this works, by the way. So, companies, there are probably still a handful out there that still do not use this in their rating process. Albeit in my office, they all do.
They do. Okay.
And when I'm talking about this, I'm talking about personal lines insurance. So we're talking about the types of insurance that are offered for home, auto, motorcycle, ATV, snowmobile, boat, things of that nature. So those are the policies that are really doing this. So your personal auto policy, of course, is on that list too. So why do insurance companies do this? That's a great question.
Well, let me ask it. Why do insurance companies do this?
So well prompted, Val. So good.
I know when to fill a hole, so go ahead.
All right. So here's the official statement. Some insurance companies have shown that information in a credit report or like a report can predict which consumers are less likely or more likely to file claims. They believe that consumers who are more likely to file claims should be paying more for insurance than those that are statistically less likely to file more claims. So if you don't have a credit history, and some folks are cash-paying people, that can sometimes impact you. Companies differ on how they address that. Not normally any kind of a surcharge, but if you're a consumer that has a really good credit history, you're more likely to save some good money. So you'd see a lesser rate if you have some sort of good standing report out there.
Right.
And we're not talking about anything that's much more than going to AT&T or Verizon and obtaining a new plan. They get your social security number. They get your vitals to see your credit worthiness when they give you a plan, and that can impact how they service you. Now, companies do vary. This is one of the interesting things. How do insurance companies use your credit history? Insurers can use credit history to underwrite your insurance or rate your insurance policy. So if you're kind of certain things about you, and I can think of a couple of my companies that are this way, certain things about your general risk, whether it be your home or your auto, that are not necessarily kind of bullseye targets of what they're looking to write, but you have an impeccable insurance score, that can go a little ways towards making a case to write you. It's not bending the rule, but you look like a good qualified candidate in that case.
So here's the issue that I have with that.
Go for it.
AT&T, when they're doing a service plan for you, they're signing a 2 or 3 year contract that you're going to have to pay. Okay. And if you don't pay, they're going to, incur a loss. But with your insurance, if you don't pay, they just stop insuring you.
They can incur a bit of a loss there too. See, and you're thinking of, if they're checking my consumer report, they're looking at whether I'm going to pay them or not. That is not what they're looking at. They're looking at statistically, you're just less likely to have a claim. That's all they're looking at. So they're looking at they're incurring a loss if you have a higher risk of loss.
How highly would that weigh in if you have no history of accidents in your whole life? You have a great driving record, but you have a terrible credit score.
The weighting is different from every company. Every company, what would be nice would be if there was some general system that was used, but every company has nitpicked their own little components.
And like you said, some don't use the credit at all.
Right. So, worst case scenario, you're just not getting the best rate. If every other aspect of you as a risk for an insurance company looks good, well, they're not going to penalize you necessarily. They're not going to surcharge you. Some of them do. I'm not going to lie. But in the general sense, you shouldn't see much of an impact.
Yeah.
But what are they looking for? So what are we using to get an insurance credit score? It's calculated using information about your credit history, such as public records like bankruptcies, collections, foreclosures, liens, and charge-offs. Public records generally have a negative effect on your insurance score. Past payment history, number and frequency of late payments in the days between due dates and late payment days, that can have a negative impact. Length of credit history, the amount of time you've been in the credit system, is another one. And then, of course, inquiries for credit can be a problem too. Numbers of open lines of credit is an impact. Type of credit card used, and outstanding debt. Again, everybody's different in what they're looking for, but those are some of the general ones that the 8 companies are using to obtain some kind of a score on you.
Right.
I'll give you an example. My wife and I got a car a number of years ago and did a 6-year payment plan on it because it was 0.9% financing through the
0.9. That's
0.9.
good.
Yeah. Well,
You can do 6 years that way.
Yeah, we paid it off faster, but because it showed a 6-year payment plan, that actually went against us for the insurance score. So
that's frustrating, isn't it?
A little bit. Yeah.
Statistical analysis doesn't always work out to the benefit.
The good news is these are things that are constantly changing. That's not we're permanently doing this, so just deal with it. I mean, they're always analyzing. So if they're going to see that this isn't working to your or their advantage, it could change. It could be modified.
It's a system, well, as with all statistical analysis-based systems, it's in flux.
Right.
I mean, because that's what it's all about, because they're always tweaking the algorithm.
Yes. There's a Wizard of Oz in the background going,
Pay no attention
How
to
can we
that.
change this today?
Pay no attention to the insurance adjuster behind the curtain.
So the thing to think about, in New Hampshire, they don't have to ask you about insurance scoring. In Vermont, we're supposed to at least ask you about it. You have the right to not do it, which means you just can't get insurance.
Through that company.
Right, through that company. We'd have to look somewhere else, or you'd have to look somewhere else. But what do we use to get an insurance score? If you've lived at your address over 3 years, your address usually is fine, date of birth. Social security number is becoming really big, but some folks don't want to share that, so there are ways around that. So
Cool.
that is my boring insurance score spiel.
Well, it wasn't boring. It was probably, for me, from my perspective, it was probably the most, I won't say troubling, but kind of annoying thing that we've
look at it
we've
this way.
covered.
The neighbor's talking about how much they pay for insurance. Now there's another reason why you don't pay the same.
Right. But the truth of the matter is that the swing may be on an annual policy $30 to $100. It's not going to be like this huge difference.
It's not. It's not huge. The bigger thing is that, and last thing real quick, because I know we're getting late. Insurance scoring is a soft hit, not a hard hit on your credit. So it does not, hard hits, which are from getting a loan or something like that, credit card, they can negatively impact your credit after enough hits. An insurance score is a soft hit. So it's a consumer hit. The only person who will ever know that was run would be you if you obtained your credit report. It'd be the last section.
Oh, that's interesting.
Yeah, so it's totally safe to run.
So it doesn't affect you like applying for a car loan or something.
Correct.
All right.
Yeah, so if 30 companies run your insurance score, so what?
Okay,
It's not going
good
to
deal.
impact you at all.
Good deal.
Yes.
All right. Thank you. Good Policies brought to you by the Barrett Insurance Agency, online at thebarrettagency.com.
Yes, and on Facebook, Barrett Insurance Agency. You can check us out at Portland Street in St. Johnsbury or give us a call, 748-5224.
All right. We'll talk next week.
All right, thanks.